The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. If you're new, I'm your host, Dan Sipe. There's some of the branch managers here at Serving Those Who Serve at Lee Sipe and Associates. I'm going to begin as I always do by saying thank you. Thank you for taking the time to watch or listen today, but also thank you for your service to the government, to the country, to me, to everyone. You don't hear that enough. You'll always hear it here. The other thing you'll always hear on FedLife is the guru, Ed Zerndorfer. He's back as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. Once again, we follow Ed's Fed Zone articles. That is his featured column, fed-zone.com, and it's one more way for us to reach and teach. So today, Ed, you're walking us through a provision from the Secure 2.0 Act that many federal employees may not have heard about, and it has real implications for anyone enrolled in the Federal Long-Term Care Insurance Program or FLTCIP, beginning with distributions made after December 29th of 2025. Certain retirement plan participants can take penalty-free withdrawals to pay for long-term care expenses, correct? So you have all the details on this.
That's correct, Dan.
Okay, take us through it.
Well, I just want to say that this is, as you said, one of the provisions that came out of Secure Act 2.0, which was passed in December 2022. A lot of these provisions were made effective down the line. This one took effect, as you say, on December 30th, 2025. And what it involves is that if one is enrolled in a qualified long-term care insurance plan, and the federal long-term care insurance program is considered to be a qualified long-term care insurance program, and they are an employee covered by a qualified retirement plan. Example, a qualified retirement plan, a 401k plan, a 403b plan, a 457 plan. Now, the thrift savings plan, which most federal employees are enrolled in, is not technically a qualified retirement plan as defined by ERISA. It was passed in 1974. It's really, there are a lot of provisions part of that came out of ERISA. One of the things was the creation of IRAs. One of the things was with defined benefit plans to make sure there was enough in financing going on with those plans so they wouldn't go out of business, so to speak. And it set the tone for the creation of 401k plans, tax-qualified 401k plans. Now, I want to point out that the TSP, while not technically classified as a qualified retirement plan, shares many of the qualities of qualified retirement plans. For example, the tax advantages with the traditional TSP, putting the money in on a pre-tax basis, but having to pay tax only when you take the money out. Employer matching, things like that, the rules regarding required minimum distributions. So the TSP is included in these type of plans in which individuals, as we're going to find out, can take money out to pay for long-term care expenses associated with a qualified long-term care insurance plan.
Gotcha. So let's dig into the problem that the provision is trying to solve. So federal employees contribute to TSP for decades, sometimes hundreds of thousands of dollars. And many of them also might carry long-term care insurance. And those premiums rise as they get older. They face a painful choice. Describe that dilemma.
I get questions all the time is, what is a good, I'm sure you do too, also, Dan, from your clients. what is a good age to buy long-term care insurance? And there are advantages and disadvantages. One of the advantages of buying long-term care insurance when you're younger, let's say in your 40s, maybe early 50s, is number one, it'll be cheaper. The premiums will be cheaper because you're younger, because most individuals do not have a need for long-term care on average until their late 70s, early 80s. But you got to remember, though, that the premiums associated with long-term care insurance are not going to stay the same. As you get older, your insurance company has the right to raise the premiums of you and other policyholders of your age as you get older. It's not level insurance. Life insurance, on the other hand, and I'm sure you're familiar with this,
Sure.
is that life insurance premiums, as you buy what's called a level term life insurance premiums, your premiums are fixed. All right. So premiums go up, but initially they are going to be cheaper if you buy it in your 40s and 50s. And the other reason is that you are more likely to qualify. Because yes, when you buy long-term care insurance, any long-term care insurance, and that includes the federal, you have to qualify. If you have certain health conditions, things like, that may result in your being denied coverage, and that includes the federal long-term insurance. All right. So let's say we have a federal employee, 45 years old, and they know based on family history that relatives or grandparents, maybe parents, had a need for long-term care when they got to the late 70s. So they decide, I think I'm going to apply for it, just to be on the safe side, to protect myself. And they find out the premiums are very, very affordable. They can afford it. They've qualified, they're affordable. All right, so the years they keep paying the premiums. They may reach a point when the premiums are getting to be less affordable, that they have to find other places to help pay those premiums. And one of those places might be the TSP. They may want to decide, listen, this is for my retirement. I'm buying this long-term care insurance to protect my estate so that in case I have to go to a nursing home, I'll have enough coverage to have them pay for the cost of a nursing home. Both, let's say, for myself, and if I'm married, for my spouse, we're going to buy a long-term care insurance. So as they get older, the premiums go up, and they are having a tough time paying the premiums. They have other expenses. Maybe they have children who have to go to college. They don't have, they have to pay for college, and as well as other places. So they decide, I think maybe, in addition to cutting back my contributions to the TSP, I think I'll take some money out of my TSP. But until the passage of this provision of Secure Act, you just can't take money out of the TSP while you're an employee. The earliest age you can do that is 59 and a half.
Sure.
Repeat, if an individual, a federal employee, wants to take money out of the TSP, whether it's the traditional TSP or the raw TSP, they have to be at least age 59 and a half. It's called in-service withdrawals. If they're younger than 59 and a half, they're not allowed to take money out of the TSP. That's the rule. Here's another scenario. Suppose you are a retiree. Suppose you're an employee, then you retire, and then you retire. You go out under a VERA, a VSIP. You retire, and you want to take money out of the TSP before 55. A lot of employees do retire at age 55 or their minimum retirement age. At that point, or for that matter, if they leave federal service, they are allowed to make penalty-free withdrawals from their traditional TSP. If they retire or at sometime during or after they turn 55. Well, in this case, if somebody retires before 55, they're not a special provision employee, I have to point out. They're going to have to wait till 59 and a half to take the money out of the TSP.
Sure. So
the employee now doesn't have that option to take money out of the TSP. Pre-Secure Act 2.0 this provision we're talking about. Now they do. They do have an option to take money out of the TSP, except for one other aspect of this law. An employer who is sponsoring a long-term care insurance program, like the federal government is the sponsor of the federal long-term care insurance program, does not, I repeat, does not have to agree that their program is going to be part of this provision. In other words, if a federal employee is enrolled in the federal long-term care insurance program and they're under 59 and a half, they're still working, they cannot take money out of their traditional TSB to pay for long-term care insurance because the federal long-term care insurance program has decided not to be part of this provision. It's an option. Again, one of the provisions of this law is the fact that an employer does not have to offer this option. They don't have to be part of the program. That's what I'm saying.
Wow. Okay. Now, also, there are specific dollar limits, right, for what can be withdrawn each year. Why don't you walk us through that?
Yeah. The dollar limitations are, by the way, we're going to talk about what a federal employee can do if they're in this position. We're going to talk about that in a few minutes. But in the meantime, let's talk about the dollar limitations. Every year, employees can request qualified retirement plan distributions up to the least of the following. This is the least of the following. The premium paid by the assessed or to the participant during the year, actual premium paid, 10% of the employee's vested retirement account balance, and for 2026, $2,600. Now that $2,600 is indexed this year. For most employees, it's going to be for this year $2,600. So in other words, Dan, if we have, let's say, and we're going to use this as an example in a moment, let's say you have a federal employee who is enrolled in the federal long-term care insurance program together with the employee's spouse, and the spouse works for a private company, is contributing to a 401k plan, and that employer has agreed to be part of this program. It has agreed to be part of this provision of Secure Act 2.0. In other words, they're allowing employees to take money out of their employees who are younger than 59 and a half to take money out of their 401k plan to pay for long-term care insurance premiums. Now, the key here is that the spouse is not enrolled in the federal long-term care insurance program. They're the company-sponsored long-term care insurance program, but they are part of the federal long-term insurance. They're under the federal employees. So the law is that the spouse can take money out of his or her 401k plan, but the spouse is under 59 and a half, and then reimburse her husband, who is paying the federal long-term insurance premiums for both of them.
Gotcha.
Of them. That is allowed up to the limit of $2,600.
Okay.
So that's one alternative.
All right, that's a plus. And the article mentions the second revolves around health savings accounts. Now, not every Fed has one, even though we encourage them. So for those who do, how can the FS or HSA help you?
Well, Dan, I love those HSAs. They are great.
I know that.
I'm pushing them to the limit as much as possible. Well, with an HSA, when you take money out of an HSA, you're the HSA's owner. You can take money out tax-free. You're putting money in with pre-tax dollars and money grows. And you could take money out of the HSA to pay for qualified medical expenses, deductibles, co-insurance, co-payments, things that your insurance does not pay for. And also, I like to add this too, reimburse you for Medicare premium payments. You get reimbursed for your Medicare premiums that you're paying each month. Also, you can get reimbursed for long-term care insurance premiums. So if this federal employee has an HSA, they can take money out of their HSA to be reimbursed for long-term care insurance premiums, including the federal long-term care insurance premiums. So that should be a push for HSAs.
Sure. Now, Ed, I know you also have a caution for our folks that's kind of embedded in the provision. So even though a penalty might be waived, for a withdrawal from that retirement plan, every dollar withdrawn is a dollar that stops compounding, right?
Oh, Dan, you said it right. It hurts me when I see employees take money out of their qualified retirement plans, early withdrawals for whatever reason. They may not be penalized in the short term, but they will in the long term. Because $1 that you take out of there means that's going to be $1 plus left in retirement. And we cannot forget about the effect of compounding. You invest $1, you're investing $1. The dollar that you put aside to your qualified retirement, like the traditional TSP or the Roth TSP, will not grow. You're taking it out. It's not growing time. And how much effect will that have in your retirement? Well, let's use the rule of 72. Let's do an example. The rule of 72 says if you have $1 to invest, you have $1 to invest, and you're getting a certain investment rate of return. Let's say 8% long term. This isn't a retirement account. Long term, you have invested in a stock fund like the C fund, the S fund. You're getting 8% over time. This is not each year. It's just over time. Average annualized return. Again, I feel obligated to this. Past return is no guarantee of future performance. So we're getting an average annualized return of 8%. So the rule of 72 says you have your $1, you're getting an 8% rate of return. How long will it take you to go from $1 to $2? Answer, divide your investment rate of return into 72. So our example, 8%, 8 goes into 72, 9 times. It'll take you 9 years. So here we have a 45-year-old employee, takes out $1 of their traditional TSP. That $1 would grow to $2 by the time they are 54 years old. It would grow to $4 by the time they're 63 years old. It'll grow to $8 by the time they're 73. By the time they're 82, when they may need long-term care to pay for long-term care expenses, they could pull money out of their retirement account to do that. That's 16. Now we're up to $32. I was just taking
Gotcha.
$1, Dan.
Right.
How about if you had about $500,000? How much that would grow?
A lot.
It hurts. It hurts, Dan, thinking about it.
I gotcha. Now, your article also reinforces there's some important eligibility nuances. You already touched on one, that employers they're not required to offer the feature, but also the employee has to be active, correct?
Yes. And again, the key word here is employee. Retirees cannot do that. If somebody, like I was mentioning about somebody who retires from federal service under a VRO or VSIP early, let's say they do it before, they get an offer and they retire before age 55. They're not eligible. Or a special provision employee, he goes out, with 25 years of service at any age. They have a traditional TSP account. They can draw the traditional TSP without penalty. They could take the money out of the TSP. They're not allowed to. They're not part of this either. All right. So the employee has to be a qualified retirement plan. And also, there are certain long-term care insurance policies that we call hybrids. They're combinations of life insurance and long-term care insurance. You have to ask the insurance company offers this, is this a qualified policy for purposes of this Secure Act 2.0? Not all long-term care insurance policies qualify. So you have to make that if a federal employee is not enrolled in federal insurance and they're enrolled in something else, in some other type of private sponsored long-term insurance, they have to check with the company if it qualifies. Usually it has to be offered by an employer. In fact, I think that is the law. It has to be. It cannot be it cannot be an individual long-term care insurance policy.
Gotcha.
Also, does this provision of taking money out of a retirement plan coordinate with state tax rules? We're talking federal tax rules here. That's another consideration. So, and there's still, I will tell you, Dan, there's still guidance being put out there. This is not the final guidance that has been put out on this provision of 2.0. IRS has to put out more guidance.
Yeah, you mentioned that that's still evolving. And this is exactly the kind of planning detail that can make a real difference for our feds. Long-term care, you and I agree on this, it's one of the most overlooked risks in retirement planning. And you have shed a lot of light on a provision that could generally help our feds who might be carrying that coverage. I've said it before, I'll say it again. I don't know how you keep it all straight, but I'm glad you do. And thank you for doing it with us on behalf of all the feds.
My pleasure. My pleasure.
Well, folks, that is a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. And please, please, please share it with friends and strangers. Ed, we've had 10,000 people watch our videos over the last year. And that's over 2,000 hours. So that just makes our day, doesn't it?
That makes my day, Philly. Great to hear.
Don't forget the live webinars every single week. Just go to the SWS website, swserve.com. You'll see the webinar button. Click it, and you get the whole menu. Yes, the guru himself will come to you, reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Your friends will want to, too. Let them know. They will thank you. Be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. And for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, I'm going to sign off like I always do by saying, good luck, Godspeed, and above all, please remember, it's your Fed life. Make it a great one because you absolutely, positively deserve it. Stay well, everybody. We are out.